Mr. Ashok Tyagi joins us now, whole-time director with DLF. Good morning, Mr. Tyagi. Thank you for joining us. Before we start, let me extend season greetings to you on behalf of all of us.
Good morning, Nikunj, and again to you and your colleagues at 80 Now. Season's greetings. Have a great year, and honestly, the way 2020 has been, 2021 has to be a better year.
But our channel checks are indicating that in last couple of months and especially last couple of weeks, there has been an uptick in real estate prices, and you've launched a project, I've been told, in just behind your office, where the response has been strong. Have real estate prices picked up, or right now it is only transactions which have gone higher?
So clearly, I'd say from the time that the unlock began, which is say about July, we reported the same in our Q2 results as well, and I think the same trend continues in Q3, Nikunj, which is that the demand is clearly coming back. And I wouldn't get into philosophical, questions like is it just pent-up demand, unlocking, etc. But clearly the demand is back. In fact, the demand is back not only vis-a-vis the Q1, which was a lost quarter, but in some sense, the demand is also better than what it was, say, a year back in certain segments. The second thing is the demand is back across segments. It's not just in the mid-range or the mid-income segment that everybody's talking about. We have seen a good resurgence of demand even in the super luxury. And the project that you alluded to, we launched independent floors, about 3.5 crores each. And frankly, all of them were sold on day one. In that sense, in fact, we are now planning to bring a sequel to that in the market in the next few weeks.
Are you surprised that demand is back? The general view is that economy is not done well. This year has been a terrible year. So why is demand back? Is it largely because of affordability and low interest rates? Because if that is the factor, then when interest rates will go higher, then demand will come down.
So I think, one is the softer aspects, which is that maybe 3 or 4 months at home, and people realize that maybe the time for investing in a residential real estate is now, given the fact that the prices are clearly, not as buoyant as they were 3 years back. And I think the interest rates have played a huge role. The fact is a housing loan at 6.5, 6.6%. is like a generational low. I think maybe 20 years back, it may have been in this range, but in the last 15 years, it definitely wasn't. And I think that is making the homes far more affordable. And by affordable, I'm not just meaning the lower end. For every segment which is entering the market, the home loan rates and the tenors today are clearly making the buying decision far more affordable and palatable than what it was. But again, the demand is back, but with a qualifier. The demand is back either for ready products or for under construction projects of credible developers. The multitude of smaller developers who used to launch purely on plan, and then the customers used to wait indefinitely for those products to be delivered. I think that demand is not back, and I don't think it's going to come back also in a hurry. So the demand is back, but with these two qualifiers.
Okay, now there is a difference in transaction and uptick in pricing. For the project which you just mentioned, I'm using that as an example, and now you said that you are coming out with a sequel in few weeks. Are you confident of demand and pricing uptick both? And how much pricing uptick you think DLF can consider, given that you have a lot of ready inventory?
So frankly, Nikunj, I think clearly on pricing, 2 data points. One is, the sort of downturn in resale prices that was there for the last 3 or 4 years. I think that has clearly plateaued out. And I've always maintained that the resale market is a far more secular market because that's pure demand supply. It's a perfect market in a classical economic sense. From a primary sales offering for most bigger developers, including us, I think that the change or the nuanced change that unlike, say, 3 years or 5 years back, you just can't price something basis your brand or your history. Your pricing has to have a correlation to what the market in that geography can handle, frankly. So if it's something that can sell at 11 to 14,000 rupees a square foot, depending on the velocity of sales you want, maybe 3 or 4 years back, you would have launched it closer to 14,000. Today, you will launch it closer to 11 or 12,000 because, you still want a price point which makes sense for the customer and at which you are reasonably certain that the product will move. So I'd still say that the demand is back. The pricing there's no longer that pressure on pricing. But I don't think it's the time to be, if I may use the word, to be foolhardy about pricing expectations as well.
Sure. Mr. Tyagi, share with us some details of projects that are in the pipeline now. We understand you've actually guided for a very strong launch pipeline. Excited to hear more on that.
Okay, so, the biggest launch that we will have in the next few months, hopefully Q4, if not, then definitely in Q1, is our Central Delhi project, which is it's a project called Capital Greens earlier, where we are already, sold about 5 million square feet in the early to mid 2000s. Now the next phase of that project should be launched sometime in the next few months. This is a JV that we have with GIC. This is eventually going to be a 8 million square feet development, and we are bringing to the market the first 2 million square feet of it. So that should be the first major high-rise launch. Then in Gurgaon, we will continue launches of these independent floors, the first of which we did in this quarter. We have sufficient land parcels, and this is a relatively low product cycle, low time cycle product. And so we'll be bringing more launches in that family. We are also planning, and right now as we speak, the entire planning process is going on to also unlock some of our residential land banks that we have, even in geographies like Chennai and Goa, which should happen sometime in the next fiscal 21-22, hopefully. And obviously in Gurgaon, we will continue to have launches across different price points and different ticket sizes. Starting from a 75 to 80 lakh ticket size, obviously going further up. I think we have those launch pipelines in place. The approval, the basic approvals are there, but the subsequent approvals are going on. And as we had guided earlier as well, our sales traction, we expect to be in the range of about 750 crores a quarter plus for Q3 and Q4, and hopefully hitting 1,000 crores a quarter going into next fiscal.
Sure. Mr. Tyagi, specifically, when we look at Gurgaon, and Morgan Stanley has, of course, said that the market is on the mend. But I also want to talk about, for instance, your Camellias project and just get a sense of the sales momentum there, because that's obviously at one end of the spectrum, but also has the largest revenue potential.
You're right. So Camellias is the uppermost end of the entire product life cycle. It also is the largest chunk of our unsold inventory. And I'd be happy to report that in both Q2 and Q3, we actually have seen pretty good traction in Camellias. And as I mentioned, traction not just pertaining to compared to the previous lockdown quarter, but frankly, traction healthier than what we have almost saw through the complete calendar year 2019. So some of those customers at the super luxury end of it also are coming back into the market for sure. Also Camellias is now, the physical completion of Camellias is there now. Almost 200 apartment owners are getting their interiors done. The club is about to be commissioned. So I think we do believe that contrary to what the popular, perception is, the demand is also coming back in the super luxury segment, while obviously it continues to be strong in the mid segment and the premium segment. But in the super luxury segment, in the last 2 quarters, we have seen a significant resurgence in demand. I think we sold 10 or 11 Camellias last quarter, which frankly is almost a quarter record for the last 2 years now.
Sure. Mr. Tyagi, since we're talking about your high-end projects and premium luxury segment, I really want to understand what's happening with pricing. While definitely purchasing power has got a leg up and thereby demand as well with, stamp duty cuts, interest rates, what have you. But have real estate prices also eased off or not?
So, just to qualify, the stamp duty cut is frankly only a Maharashtra-centric benefit. Other states, unfortunately, haven't really followed suit. So the stamp duty cuts only impacted the real estate activity in Maharashtra. But the interest rate cut clearly has been a nationwide issue. As I mentioned to Nikunja's query earlier as well, the pressure on prices has definitely eased off. I still don't believe it's the time to start yanking up prices, but clearly the pressure on prices has definitely eased off. And today, we believe that at the prices that we have for different segments, right from the camellias as you come to premium and the mid-income pieces, I think as long as you are not ultra ambitious in your pricing and you have fundamentally a sound location, good name, and a credible product, I think you'll get the pricing that you're looking for.
Okay. I also wanted to understand what's happening to rentals and, more importantly, commercial real estate. While everyone's working from home and, understanding or feeling the need to upgrade or buying their own houses, but what about commercial real estate? Has there been a demand uptick there as well, or have things been status quo?
So I'll split the commercial real estate into two segments, the offices and the retail malls. Let's talk retail first. Retail obviously had the toughest Q1 and part of Q2 because of the lockdown impacted that one sector completely. Even post-August, when the retail malls began opening up, there were severe encumbrances there in terms of cinemas not working. Even if today they are technically working, there's no software to support them. There were restrictions on F&B. There were restrictions on, obviously on the number of people you could have in the mall, etc. But despite that, the malls have had a pretty good comeback, I'd say, in the last couple of months. I mean, depending on which mall you're talking about in which geography, but broadly, I'd say it's safe to assume that malls are back to between maybe a 60 to 80% bounce back of the pre-COVID levels, which I think is phenomenal. And the mall story does look to be strengthening. I think the mall story would have strengthened even more in North, but for the Delhi resurgence of cases in the October timeframe. That obviously is now declining, but again, you don't know how this entire UK story could impact. So the malls could have these couple of shocks, but fundamentally, I think the mall sales, the mall rentals, all of those things are beginning to come back. During the first 6 months, we had given significant rental rebates to the malls also, because obviously if our retailers were not making money, I don't think we could have also asked them to give their rents. And I think that process has worked out well. Offices, which is the bigger piece for us, obviously, offices, I'd say that the collections have been extremely resilient at a 95, 96% plus. And it's not just the story for us, as you must have seen the data from the two listed REITs also. I think generally collections has been a good, strong story across. Clearly, people are holding on to signing more bigger leases. And part of that, at least, is because of the fact that a lot of the foreign clients can't get their teams on the ground to do the physical due diligence, which is such an important piece of that entire leasing process. Despite that, we signed almost a 750,000 square feet deal with the Stanchart in Chennai, which I think is Stanchart's single biggest, commitment globally, is what I'm told. So it's not that the deals are not happening, but deals are clearly happening at a slower pace than what you would like. There are certain tenants who clearly have been looking at, who have been feeling pressurized by the entire environment. So I'd say from an exit standpoint, we haven't had too many exits, but I think clearly our vacancy level, which used to be 2 to 3% normally, may go up by between 2 to 4% this year. We expect, I'd say, between 2 to 4 quarters for this entire thing to come back onto rails. But our fundamental view remains strong. We had 2 CapExes which we are undertaking. One is a project called Downtown Gurgaon. One is a project called Downtown Chennai. And we used the lockdown period to analyze the entire thing. And then we continued. We decided along with GIC to continue incurring the CapEx build out in both of those projects, because we believe that in 2 years when those projects will be ready, hopefully the demand cycle should come back. As you must have read in the papers last week, we moved ahead and concluded the transaction to buy 50-odd% stake held by Heinz in a joint venture that we had. And, that will add a further 150, 160 crores of rentals to our top line. So commercially, yes, for the next 2 to 3 quarters, the leasing momentum would be impacted for sure. But we believe that fundamentally the India story and the commercial office story should stay. Work from home also, as far as that is concerned, I think as a lot of us are also experiencing, as the time of the lockdown and the aftermath has sort of, prolonged, people are beginning to get restless. And B, the lasting impact of work from home, we believe, would also be partially at least offset by more de-densification in offices. A more square feet per workstation as a metric would clearly be a metric to be observed. So we still believe that with a 2 to 4 quarters, slight pause, the commercial office story should come back strongly.
Mr. Tyagi, thanks for joining us this morning. Good chatting with you.
Thank you.
Always.
Thank you. Bye.